Look, our target is set on a long-term view. I think most encouraging last night was that Tesla's profitability improved more than we in the street had anticipated, and on a sequential basis. So car operating profits adjusted for credits were almost 5%, relative to, closer to 0% last quarter. So that was a significant improvement. But when we think about the valuation of Tesla longer term, we think about how many cars it can deliver and ultimately at what level of profitability. And the stock is basically saying this is a company that can not only be the highest volume car maker in the world going forward, but it can also be the most profitable. And historically, those things are at opposite ends. The more volume you have, ultimately, the tougher it is to become highly, highly profitable. And the stock is effectively saying Tesla can do both. And I'm not sure that a short-term improvement in profitability in Q3 really changed our view on that.
Okay, let's talk about for those who aren't familiar with the zero-emission vehicle credits. In 2018, Tesla had $418 million of those vehicle credits they got from state or national authorities, rewarding them for being green. 2019, the buyer credits were $594 million. And then this year, through just the third quarter, it's $1.18 billion. Your point is that they had been unprofitable without those credits until this quarter when they did see a 5% profit margin on it, correct?
That's exactly right.
What can you anticipate about those regulatory credits going forward? Are they going to run out? Is it going to be harder? What do you think happens?
Right. So a lot of these credits are because emission standards in Europe increased substantially this year, and they increase again next year. And so if your carbon emissions from your fleet is high, i.e. you don't have a lot of electric vehicles, you pay a big fine in Europe. And so ultimately what companies are doing are bidding for Tesla's credits, basically saying, can I buy the credit of having made an electric vehicle that reduces my average carbon emission in Europe, and therefore I have to pay a lower fine. And so because the emission standards are higher in Europe this year, you've had a bid up and a higher demand for these credits. I think that will likely occur for at least another year. But what will happen over time is, as particularly the European OEMs come out with their own EV models, they'll be closer to hitting that standard. And so ultimately the need to buy these credits will go down, and Tesla's profits and revenues associated with them will go down.
Shepard Smith here. Thanks for watching CNBC on YouTube.